All right. So by way of background, I grew up in a retail store. Like literally grew up in it. Our house was attached to it. My mom bought this store thinking it would bring she would let her work and be close to her kids. It was after a divorce with my father. And we lived in this little store. And she was wrong, by the way. It didn't let us have more time together. Little retail stores take up a lot of time. I guess we got more time together. It was just working in the store. But um, we had so it was like a little convenience store at the base of a mountain in here in southern Arizona. And so we get a lot of people going up uh for weekend holidays, and that would stop and get, charcoal, ice, whatever, the stuff they need to go camping. Anyway, so I grew up dealing with inventory, which a lot of kids didn't, I guess. But it occurred to me that sometimes inventory is pretty easy to keep track of. If you have really expensive items, let's say like a car dealership, you have a VIN number on every car. So each time you add a car to inventory, you know exactly how much it costs you that specific car and any money you put into fixing it or getting it ready to sell to customers. But when you sell a whole bunch of fairly homogeneous inventory. So our store, let's say we had canned food, which we did. We would have canned peas, canned corn, canned carrots that people would buy. And the question is, how do you differentiate between one can of carrots and another? Even with a barcode scanner, they still have the same SKU. So unless you're going to somehow mark each can and say these were ones that were purchased on January 1st and these were ones that were purchased on February 3rd, it's very hard to keep track of. And what happens is, as we purchase from our suppliers, sometimes the prices fluctuate. Maybe we make a purchase in January and it's one price, and then it goes up 10 cents when we make a purchase in February and down 10 cents when we make a purchase in March. So the question is, if all the product goes on the shelf and customers are buying it, how do we know if they're buying the can that cost us 50 cents that we purchased on January 1st or the can that cost us 60 cents that we purchased on February 3rd? And the answer is we usually don't. Even in big modern stores like Walmart, where they have some of the best tracking systems in the world, they don't typically keep track of individual items in that way. They just keep track of items in a group by SKU, which is the barcode. That's SKU means shopkeeping unit, which is interesting, but that's what it means if you didn't know that. So anyway, because it's hard most of the time to keep track of which unit in particular you're selling of a given product, we use assumptions. And they're brought into these three types of assumptions, at least the ones we're going to learn about in this course. The first assumption is called first in, first out, which means we assume that the oldest or the earliest purchased merchant or units of merchandise we have are the first ones we sell. Okay. Most stores, if you have food storage, you try to rotate so the older stuff's on the front and the newer stuff's on the back. And so it's a reasonable way to do it. Assume that the oldest stuff is going to sell first. That's what first in, first out means. A rare number, but a small number of products, businesses will sell on a last in, first out basis. These are usually like technology or other items that are very sensitive to time. So, Apple, as an example, when they produced the iPhone 15, they're going to sell mostly iPhone 15s. It's kind of like Book of Mormons or Books of Mormon. iPhones 15. I don't think so. I think it's iPhone 15s. Anyway, so their older stuff sitting on the shelves is likely to actually go out less quickly than the newer stuff. So they use last in, first out, meaning the most recently purchased items, we're going to assume, if we don't know which item we sold, we're going to assume it was the newest item that sold. And then the third way tries to be, I guess, more conservative, since you don't really know which items you're selling, and it does that by taking an average. saying, since we don't know which one we're selling, we'll take the value or the cost actually of all the units we purchased and divide it by the total number of units, which will give us an average cost, and then we'll use that to figure out. And what we're trying to figure out is our cost of goods sold. So if I sold 10 units, then which ones did I sell? Because that's going to impact my cost of goods sold if they had different costs. And the value of my remaining inventory. After I sold those units, the ones still sitting there on the shelf, which ones are they? So we can use one of these three assumptions: first in, first out, last in, first out, or the weighted average. Just so you know, I've said it before, but in these online sorts of classes, it's really the easiest if you have a question to just interrupt me rather than like trying to raise your hand or whatever, because again, the lag, just be like, wait a minute, what is that? Or whatever, and I won't be offended. Um, yeah, I'm not that easily offended. So I had 8 kids. And so if you can't deal with a teenager telling you you're dumb, then I was in the wrong business. Now, as they're getting older, they're starting to think I'm smart again, which is super cool. Anyway, we usually, like when they go on a mission, they like write you a letter like, I just want to say, I think that I hit the parent jackpot with you guys. And you're like, that's probably overselling it. But yeah, you've seen some terrible people now and realize we're just regular people. Anyway, all right. So the way inventory works, or the way we the cost flow of it, is that we have our beginning inventory at the beginning of a period of time, say a month or a year. Any purchases we've made during that month, and if you add those two together, you get something called merchandise available for sale. That just means what you had that was available to sell during that time period. And then our ending inventory plus our cost of goods sold should add up to the merchandise that was available to sell. Another way of saying that is you can take merchandise available for sale, count up your ending inventory and subtract it, and that will give you the cost of goods sold, okay? So in other words, what you had plus what you purchased is what you have available, and then what you had available has to equal what you now have left over plus any amount that you actually sold, right? So that's just kind of a conceptual idea of how it flows. So the thing that gets confusing in this chapter is that there's 2 different ways that businesses keep track of inventory. The first is called a periodic inventory system, and the second is called a perpetual inventory system. Periodic means keep track by each period, each month, each quarter, each year. And perpetual means ongoing, right? So a perpetual inventory system keeps track as we go. So what we mean by that is with a periodic system, which is what I grew up with, we would write down. So at the end of the year, I would count the number of cans of peas. It was my job, and had a spiral notebook, and I would write like cans of peas and count them up and write the number there were there, 18, right? Then throughout the year, as we made purchases from our supplier, we would just write in those purchases. And at the end of the year, we could add up what we had plus all the purchases, and that gave us the goods available for sale. And then I would go back out and count the number that were on the shelf at the end of the year, 12 or whatever was there. You had to do this for every item in the store. Kind of stunk, especially when your mom was paying you like $4 an hour to do it or whatever it was. But hey, and so we would count up how many were there, and then I would take the amount that was available minus the amount that was still there at the end of the year, and that would tell us how much we sold. That's a periodic inventory system. It's pretty rare for businesses to use a periodic system now because the cost of things like barcode scanners and other technology have come way down. And so it lets us instead use a perpetual system where when we get cans of peas in, we type in 12 cans, scan it, it adds it to inventory, and then each time a customer buys one, when we scan it at the register, it takes one out of inventory. It's why if you've ever worked at a retail store, they're like, make sure you scan each item. You know, don't put 5 and scan it when they're Kool-Aid and they're all different flavors or something, because that's going to screw up our inventory. So under a periodic system, we keep track of things like this. We know at the beginning of the year, this business had 10 units that cost them $91 a piece. And at the end of the year, they had 12 units left in inventory. Over here, we can see that. So we know that during the year then, if you had 10 units available at the beginning, and you purchased 15 and then 20 and then 10 more, you had 55 units available. The cost of those units is called the goods or cost of goods available for sale. And then we can look at the total of their sales, 20 and 23, and see that they sold 43 units, which would leave them with 12 units. So now when we're trying to figure out, okay, what's the value of our cost of goods sales, or our what is our cost of goods sold, and what is the value of our remaining inventory, we go through this process. Oh, sorry. Okay, so now, sorry, the way this is set up is now we're going to show this using each of the methods. First in, first out, last in, first out, and weighted average, okay? And then also what's called specific identification, which isn't really a method of assuming, because it means you actually know which units you sold. Like I mentioned with the car dealership, who knows exactly which car they sold and how much it cost them. So the first type is, I guess, the specific identification, but it's not really an assumption. It's where you know exactly which units you sold and how much they cost. So there they can say, okay, with specific identification, we know that we sold 8 bikes that cost $91 and 12 bikes that cost $106. So doing that, it's pretty easy to figure out our cost of goods sold. We can just take 8 times 91 plus 12 times 106, and that gives us the cost of goods sold. And then our ending inventory is going to be our cost of goods available minus the cost of goods sold, and that'll tell us the value of the bikes still sitting there in inventory. So that is the specific identification method in a periodic system. I also recognize that as I try to go through these with you, it's kind of like someone explaining a board game to you, and you still got to play a couple rounds before it makes sense. So sometimes the best we can do is do an overview and then kind of get to the work, right? So here's a first in, first out system. We know they had 55 units available at the beginning of the year, and they had 12 at the end of the year. Oh, sorry, no, they had 55 available by including their purchases. Sorry. So here's a situation where we're like, okay, if we have 12 at the end of the year and we had 55 available, it means we sold 43 bikes during the year. And the question is, well, what are the cost of the bikes, especially since, you know, some of them cost us 119 and some of us cost 115. So with first in, first out, we're going to assume it was the oldest bikes that sold first. Okay, it's just an assumption. Let me go back a page here. So I just want to show you now what we mean by this. So we had 10 bikes that cost us $91 at the beginning of the month. We purchased 15 more at 106, purchased 20 more at 115, and 10 more at 119. So that's our total inventory that we have available to us during the month. So when we get to the end of the month, and we're saying, okay, what was our cost of goods sold? And we know we sold 43 units. Let's see. We're going to assume it was all of those earliest units. So, and that the units we have remaining are all from the end of the month. So what we do is we figure out our ending inventory by saying we still have the 10 units from the last purchase on August 28th and 2 units from the August 17th purchase. Add those together, the cost of those, and that tells us what the cost of our ending inventory was. is. So the stuff that's still sitting here at the end of the month cost us $14.20. And then we can take our cost of goods available minus that, and it will tell us the cost of goods sold. So again, I'm going to go back up two more and just show you, see if it'll clarify. So with first in, first out, we're assuming if we sold 43 units, that we sold all 10 of these, all 15 of these, and then that's 25 sold, and then another 18 of these units to add up to 43. Meaning the value of our ending inventory is all 10 of these units and 2 of these units. So you can see here, they took 2 of the August 17th units that cost $115 and 10 that cost $119, and that is our ending inventory. So our total cost of goods available minus that ending inventory gives us our cost of goods sold. So remember, with first in, first out, we're assuming that the earliest purchased units are the ones that are sold, and the most recently purchased units are the ones that are still there in inventory at the end of the month. When we do last in, first out, it's the opposite. We're assuming that the earliest purchased units are the ones still in inventory at the end of the month, and the most recently purchased units are the ones that we sold. This one's weird to me because it doesn't seem as intuitive, but it's just another way sometimes people make assumptions about their inventory system. So again, the easiest way to do this is to say, what was the total cost of the 55 units we had available for sale? And then let's assume that the 12 earliest units are still sitting in inventory at the end of the month, which was 10 units that we had at the beginning of the month times 91, plus 2 units purchased on August 3rd at 106. That gives us the value of our ending inventory, and our cost minus that ending inventory gives us our cost of goods sold, what we actually sold. The third method, weighted average. So with weighted average, what we do is we say, ooh, that's a little blurry on my end, but I have it blown up really big. Is we say, okay, we add up the total cost of all of our inventory, 5,990, and the total number of units we have in inventory. And then we divide 5,990 by 55, and that gives us, on average, we paid $108.91 per bicycle. So then all we have to do is take, to find our ending inventory, is take 12, the number of units still left in inventory, times the average cost of 108.91, which gives us the value of our ending inventory. And we can subtract that from the cost of goods available. It would also work to take 43 times 108.91 would give us our cost of goods sold. So there's our 3 plus 1, actually 4 methods: specific identification, where the problem will tell you this is which bikes sold and how much they cost. And in real life, you just know because you're running the business and you know which ones you sold. Or first in, first out, last in, first out, and weighted average in a periodic system. So now we have to look at the same assumptions, but in the perpetual system. So if you think about this as you approach this chapter, what you want to do is first recognize with the problem, from what it tells you, am I working in a periodic system or a perpetual system? And then, am I working specific identification, first in, first out, last in, first out, or weighted average within the periodic or within the perpetual? So, sometimes if I break things down to almost like a decision tree, which am I doing, it makes life a little bit easier. So, so income statement. So this was kind of to Chris's point, I think. If we make inventory errors, how do they affect our income statement? And so it's a little bit confusing. So if we understate our inventory, that means that our cost of goods sold will be overstated. Why? Because the cost of goods available minus ending inventory gives us the cost of goods sold. So if we come up with a number for our inventory that is lower than what it truly actually is, then our cost of goods sold is going to be overstated or higher than what it truly actually is. And since cost of goods sold is an expense, if our expense is overstated, that's going to make our net income look lower than it is, or it's going to understate it. And then, because our ending inventory for this year also becomes our beginning inventory for next year, it means going into next year that our cost of goods sold is going to look too low or be understated, and our net income is going to be overstated. And then for when things are overstated, it's the exact opposite. So if we're showing an ending inventory that's too high, it's going to make our cost of goods sold look too small or be understated, which will make our net income look overstated. And then going into the following year, we're going to be overstated and understated. So it's pretty confusing. But I as you work through it, it's less so if you can kind of talk yourself through that interrelationship between ending inventory and cost of goods sold, which I just showed you on those problems, or not problems, but the examples before, that our goods available minus our ending inventory gives us our cost of goods sold. Meaning if ending inventory is off in one direction, it's going to make cost of goods sold off in the other direction, because they have a subtraction relationship, I guess. And then because cost of goods sold is an expense, it's going to have this opposite impact on net income. If the expense shows too high, net income is going to show too low, and vice versa. So that is a little bit confusing. And again, explaining it here is one thing, but without looking at a problem, it's a little bit harder. Any questions about this that formulated in your head as I was talking about it, or is it, or not really, because you're like, not until I see it, a problem?
I think visually it's just easier to learn the pattern, then put the reasoning to it. That for year one, it's alternating. So if it's overstated, then the cost of goods sold is the opposite. It's understated, and then it flips for net income. And the same for understated.
Right.
Then year two is the opposite of that.
Right. And that's why I kind of like this little thing down here on the bottom, right? It shows us, like, if our ending inventory is too low here, our ending inventory for 2016 or year one becomes our beginning inventory for 2017, which is going to lead to the opposite issues happening in the next year.
Mhm.
So
Yeah, since year two kind of corrects year one, then it's just the opposite.
right, yeah, by year three, you're good. But year one and two are screwed up. And so better to figure out the issue. And again, in real life, it happens that way. You make a mistake and then you find it. Like, I've never met an accountant who never makes a mistake. I've met some who think they do, though. Think they never make mistakes. But so remember, inventory is an asset account. So on our balance sheet, if we understate ending inventory, then we're going to be understating our assets, because inventory is an asset. And since it won't change, remember, assets equal liabilities plus equity. Since it won't change liabilities or debt, it will understate our equity too. And likewise, if we overstate the asset ending inventory, our assets be overstated and our equity be overstated. So that's the relationship to the balance sheet accounts. And that's kind of it. I mentioned that there is this second way of dealing with inventory assumptions for perpetual accounts, but this course, they have it, I don't know why, but they have it dealing mostly with the periodic. So the only difference between the perpetual and periodic is that, as I showed you when I went through those examples with the periodic inventory system, It was just once at the end of the year, we had to make this assumption about what inventory was sold and what inventory was still in ending inventory. With perpetual, we do it after each sales transaction is all. And so it's not any different, still first in, first out, last in, first out. It's or average. It's just that we do it after each sale. So that's it. I hope this provides a meaningful overview of this chapter for you as you get into it.
Good question.
Yeah.
Since the income statement corrects itself after 2 years, does this balance sheet part, does that correct it? I mean, it would correct itself after 2 years, but it only shows one. So for the second year, if the inventory is understated, assets and equity are understated, does that mean that for the second year, they're going to be overstated?
So yes, because flowing into that next year, ending inventory is going to become the beginning inventory. And then, so it's going to be, actually by the end of that second year, it's going to be correct. So it's really on the balance sheet item, it's only that 1 year. And here's why, because this number we're using, ending inventory, is at the end of the year. So the error occurs right at the end of the year. So it's wrong here. And then it's wrong here. But by the end of the year, it's going to be the correct amount that's flowing into the third year.
So balance sheets are only affected for 1 year?
Sort of. So a balance sheet, so an income statement is giving us the revenue and expenses across the whole year, right? In other words, we accumulate revenues, and then that's why we have to close them out at the end of the period, let's say the year. But balance sheets are giving us the actual balance of that account right now at whatever moment is the dated on the balance sheet. So our ending inventory is going to go down as our inventory at the end of 2016. And then our ending inventory for 2017 is going to be what it says for inventory for 2017. Not measuring across the year, but just this is the inventory as of the end of the year. And so yes, because this is just a one-time thing each year, it's going to be off in this year, but by the end of the second year, it's going to be showing the correct amount.
Okay,
Because
so
in
balance
essence,
sheet.
go ahead.
So balance sheets just show you how the company is doing at this point and this point and this point. And so by the end of the second year, the balance sheet will be corrected. But anytime within the first 2 years, it will be skewampus as well.
Yeah, if we were to say do a balance sheet midway through that second year, it would still not be fully adjusted for the amount we were off.
Okay, so does that mean, so then for the second year, anytime within that year, it's going to be overstated, or if we
Yeah.
understate it in the first place, in the second year, it's going to be overstated, just like the income.
So let's see. Just let me think through it. I don't want to give you a wrong answer. So if my beginning inventory is off, in other words, it is too low at the beginning of the year based on last year's number, then
So we're
as I'm
talking about year
selling,
2.
it's got to catch up. So yes, it's going to be over until I've sold all of that, and then in essence, what I've done is I've sold over 2 years. I've sold the right amount, and I just showed too much at the end or too little at the end of 1 year, and therefore, if I were keeping track of how much I was selling during the year, it would look like I sold more in that second year. but I didn't actually sell more. So the short answer to your question is yes, it would be the opposite. It would be the opposite in that second year until we fully realized the error and sold all of that inventory.
Thank you.
I hope that wasn't. It's not a question I ever have to ask myself. Anyway, so that's kind of what I had put together for this chapter. I don't know if there was any other questions or if we're good for tonight. Anything else, I guess, before we go? I'm going to move you guys over here under my camera, or else it always looks, when I'm looking at you, it looks like I'm looking over here. But now you're right by my camera. All right. Then if there's no other questions or anything else, we could say a prayer. Is anybody thinking, I need those blessings? All right. We always need blessings.
Our Father in heaven, we are grateful to be so blessed by Brother Fox and his generosity in taking the time to explain these accounting principles to us. We are grateful for thy spirit and for how God does help us with our education and helping us to use our talents to be like thee. We pray that thou will continue to bless us with thy knowledge. In the name of Jesus Christ, amen.
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 Thanks, everybody. Have a great night.
Thank you.
I have a funny story for you, Brother Fox.
Okay.
So I was been having trouble learning online, so I went and I bought